The Kenyan shilling has been backpedaling since mid-2021 when it stood at 106.54 as the combination of weak inflows and strong dollar demand. Global inflation, supply chain bottlenecks and political unrest among major factors. As Nairobi's economy struggles, there is growing tension over capital flight and Uganda seems to be smiling in the dark. According to banking experts, Kenya's fragile shilling to dollar context, currently at 141 for $1 has in-depth undercuttings to regional financial markets and economic stability.
I have heard and read in the media things around bankruptcy, things around Kenya shilling. I think there's been a big misrepresentation of what is happening in Kenya. What is happening is the Kenya shilling is losing value against the dollar. And this is something that's been happening consistently over the last few months. It's not because there's a shortage of Kenya shillings or people going bankrupt. It is simply the currency is weakening against the dollar. So the question we must ask, why is the currency weakening against the dollar? From my perspective, there are two main issues as to why. One, the Kenya shilling is a managed float. It is not a free-floating currency like the Uganda shilling, meaning that the central bank directly or indirectly is keeping the shilling trading at a particular level instead of letting the market determine where the shilling should be trading.
Amidst the stress in Nairobi, there is a standing question of how deep regional impact could be and whether there is cake big enough for Uganda to take on. Ugandan traders that have capacity to export their produce with a value addition backing have been motivated to utilize this window since it's a temporary jackpot.
If we had capacity to now process the Ugandan goods and export them with value addition, this would be the right time. Other than, because now the Kenyans are reluctant to buy because the shilling has depreciated and therefore it's more expensive to trade. However, for us, on the other side, it's cheaper to trade in Kenya because we shall require less money to buy the same volume of goods than yesterday. And this is good for the country if at all the Ugandan traders can utilize that and take advantage of this. However, they should also know that this is a temporary situation. Whoever wants to benefit out of this temporary situation may end up losing in the long run. Those ones who may come in to speculate in the money economy between Uganda and Kenya through the exchange rates, you may have a lot to lose because the market forces might stabilize the shilling once again.
If you're doing trade with Kenya, it should be better for you because as the Kenya shilling weakens, it means the Uganda shilling is stronger, which means if you're importing goods from Kenya, they become cheaper. If you're buying Kenya shillings, they're actually cheaper. So as the Kenya currency weakens, assuming you're doing business with Kenya, it means that every Uganda shilling you exchange for Kenya shilling, you're getting more value. Kenyan company operating in Uganda will not have a problem. Probably will be a Kenyan company because of the reduced availability of dollars. Repatriating money outside of Kenya becomes difficult. But getting money in, buying Kenya shillings from Uganda shillings is easier. It's actually cheaper now. What is the real story in Kenya is the lack of availability of dollars. Meaning that if you want to repatriate your money outside of Kenya, it becomes difficult because of the shortage of dollars.
Debt burden persists for many African states, Kenya inclusive. In this year's first quarter, a few big international debts that had drained its foreign reserves were cleared and the balance was insufficient to settle future obligations or safeguard its currency against external shocks. In fact, $2 billion Eurobond is a critical and questionable reality. Observers question respective governments to monitor monetary policies and financial markets closely.
Why the Kenya shilling is weakening, it's because there are some concerns in regards to functioning of that particular economy. There are many people that believe the economy is not doing well because of the debt. Kenya's debt is increasingly becoming unmanageable. In 2024, $2 billion maturing in euro bonds. This is instruments that issue at a borrowed international market. So there are fears that Kenya currently is not in a position to repay those euro bonds.
Not have adequate foreign exchange reserves. It's difficult for you to sustain your currency strength. If there is a demand for your local currency and you do not have sufficient reserves, then you are going to have the shilling lose value. Now, these instances, when they happen to our key trade partners like Kenya, it has a lot of volumes to speak to us. Because if the Kenyan shilling loses value, then it means it's going to affect some of the Ugandan exporters, and Kenya is our big trading partner. But also you begin to say, where is the situation for Uganda itself? Are we having sufficient reserves, or are we going to find ourselves in the same space? So a lot of macroeconomics is also going to be very, very critical for what is happening at the lower level.
Bank runs and panic sales are probable during economic tension. Such a move from Ugandan banks and traders, for instance, would lead to a significant devaluation of Kenyan shilling against the Ugandan shilling, and shortage of the Kenyan shilling observed in the local forex business depends the exchange rate instability.
First, try to ensure that they protect the interests of their clientele, and also mainly protect some of their investment portfolios. Now, if you're having the Ugandan banks withdraw heavily from the Kenyan market because of the fact that it is heavily depreciating because of the fears that they are having concerning the limited cash reserves of the Kenyan shilling, I feel like they're trying to protect their interests. So if you're having such a thing, it mainly goes back to the Kenyan government in trying to work hand in hand with the Central Bank of Kenya in trying to protect and give the confidence back to some of these international banks, like the Ugandan banks that are withholding back from the Kenyan market.
Mr. Okwenje Benon gives confidence to Ugandans that with a free-floating local shilling, unlike Nairobi's currency, there is advantage for local trade and investment.
Central banks, thank goodness, is doing the right thing. Our currency is free-floating. It means that the market determines the level of the currency. Bank of Uganda does not determine or dictate the rate of exchange rate. They let the market determine that. And as long as you let the market determine where the currency is, then you'll be able to buy and sell dollars. You'll be able to expatriate money out. You know, we have the good thing about Uganda and why foreign investors love Uganda. We have a liberalized capital account. We have a free floating exchange rate, meaning the market determines the level of the exchange rate. As long as we continue to do that, we'll be absolutely fine. And in fact, we'll actually attract more foreign investment into our economy.
While Tanzania is also witnessing economic challenges, Kenya seems severe as East Africa struggles with shrinking foreign reserves. Locally, import cover stands at $3.6 billion, about 3.5 months, a slight improvement from January and February when the reserves sat at $3.5 billion, according to the Bank of Uganda. Ronah Nahabwe, Smart 24 TV, Business Today.